Happy Monday out there, Team 42. It's your skipper here, Darius to present our macro minute for Monday, October 14th, 2024. Hope everyone had a good weekend. So, as always, we'll start with our executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions, as well as what specific changes you need to make in your portfolio to remain on the right side of market risk, you need to be a client of 42 Macro. So, today's key macro question is: will China's stimulus efforts disappoint investors? Our answers are: over the weekend, China's Ministry of Finance provided dovish forward guidance regarding the outlook for fiscal stimulus. While the announcement stopped short of the 2 trillion yuan hard dollar figure expected by Bloomberg consensus, it did contain several goodies that point to a sizable positive fiscal impulse in the months ahead. The Politburo Standing Committee meets at the end of this month and is expected to approve the supplemental budget funding. While Chinese officials may wait until after the U.S. election to make further announcements, we continue to anticipate incremental fiscal and monetary stimulus will be implemented over the medium term, spurring an acceleration in China's already positive liquidity impulse. Chinese stocks, which had their biggest up day in a week at plus 2%, like what they heard over the weekend, we do not believe investors should fade this emerging bull market. Transitioning to our 42 macro dashboard here. This, as always, we'll wrap up with a question from our community. This one's titled Oblivion. Says, Darius, thanks so much for your work. Today's Around the Horn was compelling. I got a question. You've shown that to get to a recession requires policy, profits, liquidity, growth, stocks, employment, and credit to inflation and inflation to sequentially break down. The process has historically been a roughly 3-year proposition. What, in your opinion, could accelerate the breakdown of these factors? Could the dominoes all fall over a 6-month period instead of a 3-year period? And does the speed of the falling dominoes have a relationship to the size of the recession and depression? How quick can an advanced economy slide from Goldilocks to oblivion, which I'm taking as a recession? So thanks for the kind feedback. So I'll start by saying a few things on the point where the process is historically a 3-year proposition. That's the sort of from start to finish, from the time where policy first gets restrictive to the time where you have inflation breaking down durably below trend, which itself is the last thing that occurs in a recession. That is somewhere around 3 months, kind of 18 months prior to recessions when policy gets restrictive. 15 to 18 or 12 to 15 months after recession starts is when inflation really starts to break down significantly. So that is, somewhere around let's call it 2.5 to 3-year process from start to finish. In terms of what could accelerate the breakdown of these factors, obviously, if you have some sort of kind of black swan type event like a COVID, like a government shutdown in response to a pandemic, that's something that could accelerate those factors. And obviously is what we saw going back to March of 2020. But generally speaking, the business cycle itself is it's a process. It's not just a all of a sudden, we are having negative employment growth and all these negative things occur. There is a relationship in terms of how, profits policy and liquidity impact corporate profits, and which ultimately impacts growth and employment, and how the employment impacts credit and ultimately inflation. That there is a, real natural song and dance that we've identified in our empirical study of how the business cycle works. Moving back to the question here, does the speed of the falling dominoes have a relationship to the size of the recession depression? Of course, absolutely. If the faster you're slowing, the deeper the contraction is likely to be. The slower you slow, the shallower the contraction is likely to be. So that there certainly is a positive relationship there. And then finally, how quickly can an advanced economy slide from Goldilocks to oblivion? Sort of hit on that already with the COVID example. Could the U.S. economy, even though we're not the persistent leading indicators of the business cycle, are not currently aligned in a manner that suggests a recession is a higher probability event, could that we still go into recession anyway? I guess the answer is yes. Anything could happen, but as investors, we don't know anything about the future. We never have certainty about the future. But what we can have a high conviction in is in a high, probability outcomes. If we can identify what the highest probability outcomes are and consistently align our portfolio and our investment decision making in accordance with those high probability outcomes, that's the best we can do as investors. And so it's our job as investors to figure out what those high probability outcomes are. And at least according to our analysis, the highest probability outcome is that the U.S. economy continues to expand over a medium-term time horizon. So we'll wrap it up there. Darius presenting our macro minute for Monday, October 14th, 2024. Everyone have a wonderful day. Best of luck out there. We'll catch you back here tomorrow. Cheers.